Hello everyone and welcome to Sound Money Stacking. I'm trying something new this week. I offer you my recap of the news affecting precious metals, the markets and the mining sector. This is from the perspective of someone who is a long holder of physical metals and has a broad portfolio of mining stocks. I don't trade short-term movements or give short-term price guidance and trading advice. Others are much better qualified to do that. Let me know in the comments if you find this video useful and if you would like me to do this every week. Thank you very much for watching. So, looking at the news affecting precious metals the most this week. At the start of the week, we heard that Trump's pick for the next chair of the supposedly independent Federal Reserve, Kevin Warsh, has called for a new accord with the Treasury Department. This has led to many questioning the Fed's independence going forward. The announcement of Warsh, a supposedly hawkish figure who would prefer a tight control on inflation, was one of the reasons triggering the precious metal sell-off on the 30th of January. However, it looks more like Warsh will help the Trump administration run the economy hot with lower interest rates. President Trump wants a full 2% lower. Negative real interest rates, where interest rates are lower than inflation, are very likely in the short term, and they probably already exist. American savers would see no point keeping cash in the bank and will move to gold in larger numbers going forward. Furthermore, this new accord appears to be a framework for future yield curve control. This is where the Fed would fix the interest rate of treasuries, buying as many treasuries as is needed to achieve that fixed price. This is pro-inflationary and accelerates debasement of the dollar. The aim of the US leadership seems to be to grow and debase the way out of their enormous sovereign debt. This is very supportive for hard asset values going forward. On Monday, we heard that Chinese regulators have advised financial institutions to rein in their holdings of US treasuries, citing concerns over concentration risks and market volatility. They want their banks to diversify away from concentrated risk and no longer see the US dollar as a guaranteed safe haven. Whether this is a political move or not, it contributes to the de-dollarization that is well underway in the East. Also on Monday, we saw Chinese authorities taking action against 17 groups of accounts that exceeded trading volume limits during the big silver pullback. These can no longer open positions on the Shanghai Futures Exchange. They do not want to be seen as the Wild West, and they're trying to prevent some of the tactics that have been very effective on the COMEX over the years. The identity of these account holders has not been made public. Are they all Chinese speculators, or are they proxies for international parties seeking to undermine the growing status of the Shanghai Futures Exchange? Of interest is billionaire trader Bian Zhiming, who holds the largest and most significant naked short position on silver on the Shanghai Futures Exchange. Estimated at approximately 450 metric tons, he's betting against the metal through the Zonghai Futures Company, with his position exceeding the total amount of physical inventory available on the exchange, which currently stands at 353 tons this weekend. So good luck with that one. The most striking headline on Wednesday was the performance of the US Attorney General Pam Bondi at a Senate hearing on the laboured progress of releasing the Epstein files. Instead of answering questions on her office's performance, she directed everyone to focus on the Dow Jones Stock Index hitting 50,000 for the first time. Politics aside, this is another indicator that the Trump administration is now politically levered to asset prices. We should expect intervention if markets fall. Once their political success is tied to asset prices, backstopping prices becomes inevitable. In my view, this adds even more support to hard asset valuation over time. Also on Wednesday, the jobs data from the US Bureau of Labor Statistics was better than expected. The non-farm payroll rose by 120,000 jobs in January versus the expected 70,000. And of course the markets went up, gold and silver fell on this news, thanks to all the automatic algorithms reacting to those numbers. However, this all reversed once carbon-based life forms read the report fully and realised all the numbers looked quite odd. Curiously, every statistic in the report was 0.1% better than market expectations. Also, the data for 2025 were revised down by 898,000 jobs. Only 181,000 jobs were added in the United States in 2025, compared with a predicted population increase of 1.8 million. The revised non-farm payroll data in 2025 proved to be 1/3 of what it was reported each month, so you can take current data with a pinch of salt. On Thursday, a leaked report purporting to come from the Financial Times indicated that the Trump administration is planning to drop the tariffs on aluminium. This report was published on Friday morning in London. Aluminium, silver, and copper were sold off hard on the unpublished rumour. There is no actual announcement yet. Silver and copper were affected because the market had partially priced in the possibility that both metals would be subject to new tariffs, having recently been listed as critical minerals. On Friday, the US inflation data came out. The numbers were a curious 0.1% better than the market expectations. Where have I seen that before? However, it was hardly good news for the US economy. There was a 0.2% rise in CPI for January, which annualises to 2.4%, so no progress on controlling inflation. Core CPI jumped 0.3%, which annualises to 3.7%. Not only is inflation above target, but the trend is up. Interest rate cuts by the Fed will fuel this inflation further. So, looking at the gold price chart, we can see that gold has closed at over $5,000 per ounce for the week for the first time in history. This is a really significant moment and is going to trigger a lot of things, such as macro discretionary funds buying more gold as they just follow trends. Now, I just wanted to show here that over this last run since 2024, there's a pattern to how gold price increases, and it goes up in a stair-step manner, where there are periods of buying. Initially, there will be a run of about 20% or so, followed by a period of sideways consolidation as the market digested the new price. And as time has gone on, the size of these runs has increased to over 30%, with 34%, 32%, and the last run being 41% rise in the price in gold in a very short space of time. So if we look at the most recent few weeks, we can see that there's been quite a large pullback in the price of gold on the 30th of January, but since that time, gold has recovered quite a bit of its price, and it does appear that it is still trending upwards. Now, views are mixed amongst different technical analysis out there. Many expect a period now of sideways consolidation in the gold price for several months. Others don't see it that way and see that the demand for gold is so enormous that it will continue upwards in the very near future. What we can say is that there's very high volatility in the price of gold. $100 a day moves in gold are no longer unusual. Changes of more than 2% a day are no longer unusual. Looking at silver, we had the big breakout to all-time highs in November. There was some resistance in the low 90s. This is the level of the measured move when you look at nominal charts, so just looking at the price alone in dollars. If you don't know, whenever you see a cup and handle pattern on a price chart, you can measure the height of the cup and add that to the top of the handle, and this is the expected so-called measured move. and prices nearly always play out as predicted. The cup and handle pattern for silver over the last 45 years really is textbook. However, we are looking at a nominal chart priced in dollars over decades when the dollar has devalued considerably in that time. The true measured move is still happening. And if you're to look at this correctly, which I don't have time to cover today, you should expect a tenfold move for silver from the breakout. And this takes you to around the $500 per ounce area. Now, I do believe something like this will play out over time, but this will not be a smooth ride and is unlikely to happen in a couple of months. So if we focus in on what silver has done in the past year, so the blue line there is that breakout line, that historic breakout line of just over $50. And we can see that silver really struggled through 2025 in the low 30s, just tracking sideways, crawling along. It got knocked back during the Trump tariffs in April 2025, recovered from that quickly, but still went sideways, largely didn't do very much at all until September. In September is when that first very large run in gold happened. And that is when silver really started to catch a bid and started to increase in price very quickly. And by November, it broke through its all-time high. Now, it didn't break through that critical line of resistance, but knocked on the door multiple times. It rejected that and pulled back. And notice that whenever silver price extends away from this 40-day moving average, which is the blue line I've plotted on here, then there tends to be a period of profit taking by speculators and the price gets pulled back to that moving average. The 40-day moving average for silver is a very useful thing to look at. Then silver tried again, knocked on the door in November. It rejected and came back to the moving average again by the end of November. And then as we got into December, finally, silver broke through this historic resistance line, stayed above it, tracked sideways for a little while as the market digested this event. Once it was satisfied that this was a real number and the silver price was staying above this historic level in price, then it broke out. It attracted lots and lots of speculators, lots of people came in, and the price really ran and ran and ran. There were periods of very high volatility, which is shown by these higher candle sizes. This is a daily chart, so very large daily movements, and up it went, all the way up to $121 before the huge pullback on the 30th of January. When the market was clearly extremely extended from that 40-day moving average, and a number of holders of silver contracts decided to take profits and bring the price right back down. So if we look at the action this year in detail, here we can see that huge pullback in silver on the 30th of January. The price since then has been extremely volatile, but has stayed within a range between around the $70 mark as support and between that sort of $92, $93 mark as resistance. So that $92, $93 mark, that is the limit of the measured move when people look at a nominal chart and measure what the cup and handle should do. So clearly people have got that number in their heads and like to sell if silver gets to that level. We saw another sell-off on Thursday the 5th of February and another sell-off again on this Thursday on the 12th of February, all for different reasons. So what we can expect going forward is that this level of volatility is going to continue. Silver's probably going to trade within this range for a while. And what we are looking to see is that this volatility calms down, the price concentrates down. It might go all the way down to the bottom end of this range. And then once it's settled, then investors and speculators will get back in the market again, and it will probably resume its rise again. We will know that silver's moving up to a much higher level if it breaks through this 92, 93 level resistance and stays above it. If that happens, then the next big move is underway. We've really no idea how long it's going to take for this to play out before it breaks through this next level and moves forward. Now, I follow the trading of the paper versions of precious metals on the COMEX and the Shanghai Futures Exchange as closely as I can. I don't trade in futures and options, but these markets do have a major say in the spot price of the physical metals. I just want to understand the reasons behind the sharp pullbacks that are frequently seen during precious metals bull markets. Now, I follow a lot of different voices on X and on YouTube, and I read quite a few Substacks. I like to hear everyone's opinions before I form my own view. Many are convinced of market manipulation and price suppression. Others think these futures exchanges are working perfectly. I think the truth probably lies somewhere in between. Now, if you want to understand the COMEX better, I recommend watching a video by Rob Keynes of the Freedom Report that he did for Kinesis Money this week. He looked through the most recent Commitment of Traders report, or COT report, from the CTFC, which covers all the trades made on the COMEX during the January 30th sell-off. He also explains what happens if silver runs out on the COMEX, that is happening. Now, force majeure is unlikely to be called, but defaults and payments in cash will likely happen. It does look like many traders close their positions in gold and silver simply to take profits from the recent run-up. The timing of this sale was probably triggered by repeated margin requirement increases by the CME, which is the group that manages the COMEX Commodities Exchange. Margin requirements are how much real money a trader has to pay up front when borrowing funds to buy a futures contract on a margin account. Increasing margin levels reduces the amount of speculation when the markets are deemed to be running so fast that they put the integrity of the market at risk. In theory, the margin requirements could be raised all the way up to 100%. I anticipate that they will do this at some point in this bull run, in addition to imposing strict position limits in order to keep the COMEX intact. Going back to January 30th, the first set of contract selling triggered stop losses, which caused others to sell, and there were highly leveraged traders who got margin called. This resulted in a waterfall of sales triggered by whoever the first movers are. I do think these first movers could be classed as manipulators, as they probably know everyone else's positions and how they will act in a sell-off very well. They chose to start selling in quiet periods of low liquidity in the market in order to maximise the impact of their desired trade. Why was the trading on the COMEX not halted? There is a so-called circuit breaker on the COMEX that if the price of a commodity falls by more than 10% in the past 60 minutes, trading is stopped for 5 minutes, and then trading is stopped for longer periods if the selling continues at an extreme pace. This is designed to allow traders to take a breath, reset their stop limits, and calm down. This didn't happen. Why? Because the sell-off didn't meet the precise criteria of the circuit breaker. Clearly, anyone wanting to push a large sell-off has got sophisticated algorithms to manage the trading behaviour and avoid triggering a market pause. Now, it's noteworthy that JP Morgan closed out all of their silver short positions right at the bottom of the dip. Now, that was lucky, wasn't it? Looking at the past week, there was a quick recovery up to $85 for silver after the big pullback. Then on Thursday, there was another rapid sell-off. This appears to be due to a leaked report that Trump will drop tariffs on aluminium, as I mentioned previously. The markets inferred that the likelihood of tariffs on silver and copper had fallen. Copper and silver were sold. Silver fell by 10.5% on the day. There were also pullbacks for platinum, palladium, crypto, and the stock market due to this indicator of economic weakness. Going forward, mainland China has their Spring Festival and Lunar New Year holiday. The Shanghai and other commodity exchanges are closed for just over a week and reopen on Tuesday, February the 24th. The Hong Kong exchange is closed between February 17th and 19th. Singapore is closed between the 17th and the 18th. That means much of the industrial demand for physical silver may pause for a week, but there will be pent-up demand when they return. Demand for physical silver has fallen in China the past couple of days ahead of the closure due to, in part, increased margin requirements on their own exchange. US markets are closed this coming Monday for President's Day, and the Canadian markets are also closed for Family Day. So, my message to everyday stackers and investors who are like me and are only interested in the physical metals is that you need to understand that pullbacks are a natural pattern of precious metals in a bull market. Overall, the price goes up over time with very big gains for those who can stay the course. However, there are periods where the price goes up too quickly as speculators join the market to make a quick buck. If the price stretches too far from moving averages, it triggers the big banks and funds to take profits. There is herd mentality and short-term thinking that dominates the markets. These sell-offs can be large and sharp. The stronger the bull market, the more volatile the price action, with sharper pullbacks and quicker V-shaped recoveries. Now let's look at the gold and silver ratio, which is just the price of gold divided by the price of silver, both of which priced in US dollars. And we can see that the ratio is currently 65. It has fallen all the way down from a high of 107 in April 2025, and it fell as low as 43 at the end of this January. Silver corrected far more than gold in the last couple of weeks, and the gold-silver ratio has climbed all the way up to 72 before coming down to the current level of 65. What a wild ride. I expect silver to considerably outperform gold this year, but it is far more volatile. If you are stacking, I suggest you keep focus on your schedule and seek the best value every time that you buy. Ignore all this market noise. If you want to load up more during dips and hold off during run-ups, then fine, but I would not get any fancier than that. Finally, in this market summary, it's worth pointing out that the S&P 500 may now be completing its topping process. The end of stock market bull periods are generally very slow to top, and markets continue to rise despite underlying factors clearly pointing to a recession being underway. The S&P 500 has bounced back since the Trump tariffs last April, but that now appears to be turning downward. The index has traded within a rising channel since the pandemic. It hit the bottom of this channel after the Trump tariffs, but then rebounded really well with all the optimism around AI. However, the air seems to be being let out of this bubble. The rising trend line, which was support, has been broken, and the S&P 500 index is now forming lower highs. I expect the index to head towards the lower part of the channel over the next few months. If we look at the Magnificent 7 stocks, the largest market cap stocks in the S&P 500, they are now some way off their all-time highs. Microsoft left its price channel at the start of this year, and that has been followed by Amazon and Tesla, and most recently Nvidia and Apple prices are breaking down. The circular co-funding that has pumped the AI narrative between all of these companies may have gone past its use-by date. AI will be a core part of our economy going forward, there's no doubt about that, but the cost of building data centers and powering them has not been priced in by the markets, in my view. I also don't think the capability of current AI tools has been demonstrated. We are some way off true AI, in my view. One thing to look out for next week is the US Supreme Court Opinion Day. That's now been scheduled for Friday, February the 20th. This might include a ruling on the legality of the Trump tariffs from last April. This coincides with the New York Stock Exchange options expiry, so this could be a very volatile day on the markets in general. Looking at the precious metals mining sector, I'll discuss this week's quarterly earnings from producers, then news events, then the price charts to close out this video. I should point out to those that are not aware that I am active on the Trading 212 platform. I make posts on there, and I also have 2 baskets of mining stocks, which are known as pies, that have been used by thousands of other investors. One is for gold and the other is for silver, and consists of the best producers and developers. These have been shown to outperform the exchange-traded funds for miners over time. I've left a link to these pies in the description. There's also a referral code where you can get up to £100 of shares for free if you are new to the platform. I think I get a small reward too if you join, just for transparency. I really like the platform as it's easy to use, there's no trading fees, and I use their stocks and shares ISA to avoid capital gains tax on my investments. So I'm happy to recommend it. I have no other relationship with them. So looking at earnings of the miners, 2 big companies reported earnings this week. Agnico Eagle Mines, with the ticker AEM on the New York Stock Exchange, they reported strong results, beating earnings and revenue expectations. They had a Q4 2025 revenue of $3.6 billion, which is up 60% year on year. The 2025 free cash flow was $4.4 billion. They remain a low-cost producer with an aggressive growth plan for the next 5 years. It's an excellent performer. Silver Core Metals, with the ticker SVM on the Toronto Stock Exchange, reported quarterly revenue of $126 million, which is up 51% year on year, and a record free cash flow thanks to all the rising silver prices. However, they posted an earnings loss due to a value adjustment on its derivative liabilities, which is complicated to follow. Nevertheless, the company is in really good shape. 72% of its income comes from silver at a time when silver price is rising. It's a low-cost producer with several mines in production. Looking at the news, Viszla Silver, which is trading on the New York Stock Exchange under the ticker VZLA, is a Canadian developer trying to build the Panuco mine in Sinaloa, Mexico. It's a very large silver asset that they are building. They've secured the funding and they're just awaiting final permits for the go-ahead. Now, there have been rumours that the Sinaloa cartel have made threats and demanded a substantial share of profits from the future mine, and these have been rebuffed by management. Sadly, 10 miners were kidnapped from their homes in a gated community near the mine on the 29th of January. And since then, 10 bodies have been found on Monday the 9th of February, 5 of which have been confirmed to be the Viszla miners. The other 5 are still missing. The stock has fallen 50% from its peak since this event began. It's a really awful situation, and my thoughts go out to the families and friends of all of those involved. There were reports of gunfights on Wednesday as the Mexican Navy helicopters clashed with armed groups. They arrested 9 suspects and killed 1 assailant. Ongoing government operations have deployed over 1,600 troops to curb escalations where lawmakers and miners have been attacked. I suspect that given the critical mineral status of silver in the USA might get involved in tackling these cartels more directly if Mexico does not do a sufficient job. I am an investor in Viszla. I think they're a great company and very well run. And the reasons for my original investment remain. I think it's very likely that they will build the mine, but they may continue to face difficulties when doing so. Orossur Mining, traded on the London Stock Exchange under the ticker OMI, put out its maiden resource estimate for the Pepas gold and silver deposit in Anza, Colombia. This came in at 200,000 ounces of gold graded at 5 grams per tonne on average. Now, this was smaller in scope than investors had hoped for, so the stock has fallen back and is now 50% off its all-time high. I am an investor in Orossur, and one thing I would say is that I've seen time and time again that mineral reserve estimates get updated and scaled up over time. Companies often focus on just getting the first maiden resource estimate out with the most reliable drill data they have at the time, so they can proceed with feasibility studies and getting funded for the mine. The drill data we've seen so far clearly indicates that this deposit is likely to be much bigger than what is mentioned in the mineral reserve estimate. So, looking at the charts for the mining company stocks, the mining stocks have performed very well this past year, with the GDX and SIL exchange traded funds, or ETFs, which are the funds that consist of the largest gold and silver producers. They are up 146% for gold and 172% for silver miners, respectively. However, it's still very early in the bull cycle for miners. It's important to look at ratio charts for more context of where we are and where things are going to be heading. So, if we compare the price of the largest gold producers, which are represented by the GDX ETF, and we compare that to the price of gold, we can see that the miners are only just starting to break out of a long-term bear market. It is the same story if we compare the gold producers to the S&P500 index. Now, the tide has turned, a bull market has begun, but there is a many multiple repricing for miners laying ahead of them. We see a similar story for the largest silver producers versus the price of silver. They have only just started their own repricing, and this typically is very fast and very dramatic. So it's very early in the bull cycle for the miners. The big payday for mining investors comes when bond markets weaken due to excessive sovereign debt, and broader economic weakness causes the main Dow and S&P 500 markets to fall. I do believe this process is underway, but it will be a slow unwinding, especially as the Trump administration wants to do everything to run the economy hot. Eventually, many will look to the safety of gold and will invest their money into the cash machines that are the mining stocks. So there's a generational opportunity unfolding for those prepared to take the risk. It's definitely not for everyone, but fortune favours the brave, is what they say. Well, that's it for this weekly recap of the precious metal space. Let me know what you think in the comments. Should I do this again next week? Is there anything that you think I've missed? Thank you for watching, and see you in the next video.